Good evening, everyone. Once again, this is our last session, the bonus session. You can see it also that I've changed the logo from Wawa Muster to Gig Institute on the presentation. The reason is that I've changed hats, even though it's an invisible hat. I'm now speaking to you as a gig wealth coach rather than as a Wowhammer. And so we're going through the three generational investment strategy, or the three generational approach. We often refer to it as well as 3G, not to mix up with 3G and 4G on the cell phones. This is the 3G of the three generations, right? So tonight we're going to look all around or learn more about that. As I told you, I'm a wealth coach at the Gig Institute and Gig CFI. Gig stands for Generational Inheritance Group. Has been founded a few years back, I think in 2011 or somewhere around there, I believe. Has been founded then, and it's all about generational wealth creation. It's all about teaching people, discipling people in a way in financial literacy, but in generational financial literacy. So the Gig Institute was first. It was all about education, about teaching people, about having groups of people coming together, learning about the generational inheritance, the 3G mindset, three generational mindset. And then the Gig CFI, the Cooperative Financial Institution, came along a bit later as a tool for the people. So what happened is people learned more about three generational wealth creation, but they didn't really have a tool or didn't even have an institution that would help them because by and large, the banks, they don't think in that way. They have their own ways of creating their wealth on people's money. And so the Gig CFI came along, was created, was built as a cooperative. And the cooperative means basically it's from the members for the members. I'm not going to talk much about the Gig CFI tonight because it's not really about that. It's more about the mindset behind it. So we're going to focus much more on that. But this is just a short introduction on those two institutions, the Institute and the CFI, which I'm involved part-time as a passion of me because I love to see people equipped and empowered in terms of their financial literacy. So the Gig Institute was built on that one verse in Proverbs 13:22, where it says, "A good man leaves an inheritance of moral stability and goodness to his children's children, and the wealth of the sinner finds its way eventually into the hands of the righteous for whom it was laid up." Now this is from the Amplified Version, thus the brackets there of explanation. So it's about a good man or good woman that leaves an inheritance. So it's not about leaving legacy or about leaving a good reputation, but it's about leaving inheritance. It's about inheriting something, passing something on to the next generations. That's something that was already installed, and I think we talked about that in one of our first lessons, was already installed by God on Abraham, that Abraham was blessed to be a blessing to the nations. And this is similar now, picking it up here in Proverbs, to leave an inheritance of moral stability and goodness to not the children, but the children's children. So it's about the grandchildren. So we should always keep actually the third generation in mind when we do things, when we plan our estate, and when we build wealth. And then it says, it adds on in the second part, and the wealth of the sinner finds its way eventually into the hands of the righteous for whom it was laid up. So it's not a concept that we as the godly men and women will run after the wealth of sinner, but it's a concept where the wealth of sinners will find the way on its own into the hands of the righteous. So by applying some of the three generational principles and the principles that we've learned also throughout the last lessons 1 to 4, we will eventually attract even wealth of the sinners, whether it's for us personally or whether it's for us as an institution. That doesn't matter so much, does it? But reality is the wealth of the sinners will eventually start serving the purposes of God. And we see that in examples like where the lottery starts supporting some ministry and so on. So there's different ways of how this can manifest, or how this can show. But I don't want to go into much more details there, because today we really want to focus on the first part here. Inheritance, leaving an inheritance for your children's children. And how does that work, and how do we approach that in our estate planning? So there's 3 different generational mindsets, right? We have the 1 Chi, the Chi 1, as it says there on the 80, it says Chi 1. That's a 1 generational mindset. And what happens there is, I always call it the microwave generation, right? We've talked about that before, I think, in our sessions, where you put something in the microwave and 30 seconds later it comes out warm. So we opt for instant return. We think for ourselves, me, I, and myself is important. And so if you have a 1 generational mindset, you assume that you will probably get around 80 years of age. That's sort of an average that we just assume now. I mean, different countries will have different averages, but we're just assuming an average of 80 years of life expectancy. So then that's sort of the focus, the scope that you will have in a 1 generation mindset. You assume by 80 you'll be dead. So you will work towards having enough money to make it until you're dead. You're not thinking about leaving an inheritance. You just want to make sure that by the end of your life, you didn't go hungry. And a career peak with someone in the 1 generational mindset is usually around 50. Why 50? Because usually they work, they employ employees, they found a job, they work hard, they maybe sustain a certain level of income there. But by age 50, they start becoming they start belonging to the old guys. And old guys are not necessarily very appreciated in the economy. Wrongfully, because they have a lot of wisdom and knowledge and expertise, but oftentimes the ideal workforce is between 25 and 30 in the mindsets of businesses, oftentimes. So a career peak is around 50. That's when maybe you have your highest salary, but then from there onwards, it might actually decrease. You maybe retire at age 60, 65, whenever, and then your income decreases again because now you don't have a salary anymore. If you were wise, you have a bit of a pension, but yeah, your income has a tendency to decrease until age 80, when all your money will be eaten up. So that's sort of the model of this 1 generational. Then we've got the 2 generational mindset. That's someone that doesn't just think for themselves. They've learned to think for their children, for the next generation. And when I say children, it doesn't need to mean that it needs to be your children. If you are childless and you will never have children, that doesn't mean you can't live a 2 or 3 generational mindset, but it's the next generation. So you could live and plan for the next generation or generations if you wanted to live that model here and after Proverbs that we just read. So on a 2 generational mindset, we're talking about the peak of your career around 65, 70, somewhere around there. And then your income and assets or wealth that you've created will last further than your death, which might be around 80, and it will actually still last to help the next generation get a bit of a startup. However, by the time you die, if we assume it's 80, your children will also already be maybe 50 years of age or 60 years of age. So it's not really helping them to start in life. It will just help them to get started in pension, really. So this is the 2 generational mindset. And then if we look at the 3 generational mindset, the assumption is that the peak income or peak wealth will be somewhere around 80 at your time of death, basically, or life expectancy. And then it will not last just for your next generation, but it will last for the generation after the next generation, your grandchildren. And they will be around maybe 20, 25, 30 years of age by that time. So it will actually be a beautiful kickstart into their adulthood and family life, where it can really help them, elevate them onto the next level. So then literally you can say my next generations could stand on my shoulders and build from there and build even higher. Now, again, when I speak wealth, right, you keep the context from our previous sessions. We're not talking about becoming rich and you know, being able of buying a new plane and 7 new cars and all that stuff for the sake of becoming rich. No, we're talking in the context of building wealth to be a blessing to others. So yes, we're talking about taking care of you and your descendants, but at the same time, we're also talking about how can now this become a good foundation, a good basis of becoming more of a blessing to the people around us, outside of our family as well, the community around us. But this is just to explain shortly the 3-generational mindset. I hope this makes sense. Is there any questions on that before I continue? If so, just unmute yourself and then you can ask your question or make a remark. If not, okay, I don't see anyone, then let's continue. So GIG has created this 3G journey map, which I slightly changed a little bit with some of the expressions, but it's the same thing. So most of us find ourselves somewhere on this journey. So not everyone is maybe at the pain level, you know, but somewhere, some people, they start at the level of pain where they are hopeless. Their income is less than their expenses. So income minus expenses equals a minus. So you will have a deficit each month because your income is just not big enough to cover your expenses. So in other words, you could say at the end of your money, there is still a month left, right? So that's the people that really don't have much hope. Because if you're constantly running at a loss in your private personal finances, there is not really much to hope for. There's really just devastation and pain, hopelessness. And so some people might start there. It's most likely not you, otherwise you wouldn't afford to be on the internet right now. But there's definitely people that you may know that are on that level. And with a 3-generational mindset, you can, once you've really grasped it and get it, you can actually start bringing hope to the hopeless and help them to engage in a journey from a 1-generational mindset to 3-generational mindset. Then the next step would be the hope phase, where if you start having an income that is bigger than your expenses and start having a surplus, even if it's just 1 rand a month, it's a surplus. And then you can already have a little bit of hope, because now at least you can save 1 rand a month for something, you know, or you can see that there's a little bit of overflow that you can reinvest into God's kingdom. But there's hope, there's something surplus. And of course, some people, they're in the hopeless phase because they just spend too much. They do have an income, but they keep on spending too much. And that's why they have a deficit, a minus. So they can just start saving on expenses and start spending less, or buy cheaper, buy wiser. But for a lot of people, the expenses is not the first issue. It's the actual income that is lacking, that there's no income or far too little income, far below a living wage. And so, so to move from hopelessness to hope, there needs to be a few changes. There needs to be equipping, like some people, we might, you know, in our ministry, for example, we still have soup kitchens, right? But that can't be something that needs to be sustained. We need to also offer help on how can we develop people now so they can start having their own income and afford their own meals, so they don't depend on the soup kitchen anymore. So there needs to be different steps. And moving from hopelessness to hope, that would be one of the steps to help people to get their own income, to be able to have enough of their own income to cover all their expenses and still have a little bit of a surplus at least. Then the next level would be choices. So from hope to choices would mean we teach people not to just have one income, but we help them to generate more than one income stream. And that can be through investments, that can be through different jobs, through business ventures, through all kinds of different things. But to teach people that it's not wise to just depend on one source of income. In missions, I often even tell people that are living on support, don't just live off one supporter, right? If you have maybe one church that supports you for missions, that's a very unsafe way of living, because once that church doesn't believe in you anymore, or has financial difficulties themselves, or whatever the reason might be to stop their support to you, it will basically mean you without any support, and you will immediately drop down into the hopelessness, because now all of a sudden your income is gone. So even in a missionary type of setup, it's not wise to have one supporter, one income stream, but rather build a network of supporters so that you have stability there. And then think outside of supporters as well. And that's what we're going to look at tonight a little bit also, is there maybe from your surplus that you have, or within your budget, within your close circle that we've talked before, can you maybe start saving some money towards pension, towards investment, towards your children's education, and so on. And then start investing that money wisely so that you have an extra stream of income, even if it's a small stream, but if it's an extra stream, it will start giving you choices, start giving you options. And you will see that once you've started living in that way, it will develop into more and more. But you need to start somewhere. If you don't start, you will not see the more. But if you do start, you will start seeing the more. And then the next, or the last level on the journey to 3-generational mindset would be impact. I call it the impact phase, where you live your full potential and you impact the people around you, or the community around you. And so you're no longer just focused on yourself and your family. You're now really focused on a big, large scale, and how can our wealth that we've created now benefit the larger body and the larger community, and how can we now help others to go through those steps so that they can become impactors. So the heart is always to go back in that circle and help others, to draw them along, and to draw others along again, and others along again, so to help them to have a 3-generational mindset. Any questions on that? Just clicking through the list here. I don't see any hands up. So, all right, then let me move on. Practical steps for your 3G strategy. So we want to make it very practical tonight. I was just laying the foundation now with the first few slides, and now let's go right into it. So the first practical step I would suggest, I will propose to you, is what we've talked the last few sessions, is agree with God on your personal close circle. So that's sort of the foundation that I would propose that you start there. Live those principles that you've learned the last few sessions, agree with God, have your close circle, and start living that one. Make it work for you before you even go any step further. And then get out of consumer debt as soon as you possibly can. So that's part of the closed circle principle that we've talked. We touched on consumer debt last week. Get out of it as soon as you possibly can. Plan it in your closed circle as an obligation to do those installments, to pay them off, and get rid of those debt, consumer debt particularly, as fast as possible. And that will then again empower you to have money available now for investments once your debt is cleared. Because now you've gotten used to pay those installments. Once you've paid those installments or those debts, you clear those debts, then don't spend those installments now on consumer goods again, but rather use that habit of having to pay something to invest that now into assets or into wealth creation. And we're going to look on how that will work or could look like. And then engage on the 3G journey. Ask yourself, where am I in this journey? Am I in the hopeless phase, in the hope phase? Am I in the choices phase? Or am I in the impact phase? And you might be between some of those phases. Like some people might be in the hope phase and already have some choices, but they're not really yet at the level of choices that they wish to be. Or some people are sometimes in the hope phase and sometimes in the hopeless phase, depending on the month, how it goes, right? So you might be in between, but find out where you are, determine, and then you have a good place to start and to put your focus on. If you're in the hopeless phase, there's little reason why you should already think about an impact. I mean, you can dream of the impact and you can put that as a goal and write it down as your vision. But your next step to focus on should be hope. If you're in hopelessness, first of all, try to get into the hope phase and get help. Get someone to walk alongside and help you. And then the next would be money wise. Live a generous life. So I can't emphasize that enough. You know, when we speak about building wealth, it's so quickly misunderstood that I'm supposedly preaching a prosperity gospel and I just want people to get rich. No, that's not what I'm talking about here. Yes, I do believe that God will prosper us if we follow his principles and obey his voice. But it's not about prosperity for our own sakes. It's about prosperity to be a blessing. So live a generous life. It says in Matthew, give and it will come back to you. Good measure, pressed down, shaken together, running over. And so if you do live a generous life, you will also see that God will continue to bless you. And you know, it's a principle that doesn't just work for Christians. There's business guys that are totally non-Christian. They even say, I don't believe in a God, but they know that the principle of giving is a valuable principle and will give them more success in their business. And they even preach. They wouldn't call it preach, but they teach that principle in business schools. Give, bless others with what you have and the surpluses, and not even just surpluses. Give as you live a generous life. But it is a very biblical principle, and they're just borrowing it from the Bible. But how much more should we then borrow it from the Bible, since we are Bible-believing Christians? So let's live a generous life. And then save money for asset creation. So in your close circle, don't forget about asset creation. You may call it pension, you may call it assets for your children's schooling, you may call it savings for your own house, you may call it whatever, but don't forget to put it into your close circle and then ask God for his agreement. And he will tell you how much he will agree and how much he will not agree, but include that in your planning and in your discussions with God. Don't exclude it, don't forget about it. And then invest in assets. You can start small. So when you plan to save money and you start saving money, and even if it's just 100 Rand a month, if that's all you can afford, then at least do that. Give it a purpose for something particular, and then start investing that 100 Rand every month wisely, so that you can start creating new assets. In GIG, the CFI, the Cooperative Financial Institution, there's a plan that was installed particularly for people that don't have much. And you can there save 100 Rand a month for 1 year, for example. That's just an example now, but the minimum is 100 Rand for 1 year. Then you saved up 1,200 Rand, interest-free. They don't pay you interest in GIG CFI. You just save it in their account for 1 year. So after 1 year, you will have 1,200 Rands. And then you can borrow money up to 3 times as much as what you've saved. So if you've saved up 1,200 Rand, you can borrow 3,600 Rand interest-free, because you also saved interest-free, so they don't charge you interest. There will be a once-off administration fee, but it's a once-off when you install the loan, and then it will be interest-free. But if you have saved for 1 year, you have to also pay it back within that 1 year, within the 12 months. If you've saved up for 4 years, you can then also pay back the loan. You can also take out the loan 3 times as much as what you've saved for the 4 years, and then you pay it back over installments over 4 years. And so it's a beautiful system. It's basically done after the example of the Stokvel. It's a very African way of doing savings. It's just been more, institutionalized and regulated. The GIG CFI is even regulated by the South African authorities as a CFI. And so it's a regulated way of saving and taking out loans, but it empowers people to start saving with 100 Rand a month and then all of a sudden invest 3 times as much into an asset creation and start building something that will give them an extra income stream. So that money is not for consumer debts. That money is supposed, that loan that you take out is supposed to create assets. So that's one example, but there's many other examples in the market on how you can invest even 100 or 200 or 300 Rand. I know one, it's called impact farming, for those of you who have not heard about it. Something also in South Africa where a company is offering shares in farming. So you can buy blueberry bushes from a farmer on his farm. He will maintain it for you. He will harvest, he will sell it, and then you get a share of the sales. And a blueberry bush costs 350 Rand. And so there's an app you can download on your cell phone, and then you can start investing 350 Rand at a time. And it's a long-term investment of I think, 8 or 10 years or something like that, the life expectancy of a blueberry bush. And then you get a regular, I mean, that's twice a year, there's a harvest, and then you get your return from that harvest. And depending whether it was a good year or a bad year, you get a bit more or a bit less, and so on. So there's ways, and that's just one example again, where you can invest smaller amounts of money and still already get a return that is fairly good. I think the expected return on the blueberry bushes is somewhere around 10% annually, averaging over the 8 to 10 years. So initially you'll get a bit less because the blueberry bush is still young. As it grows older, there's more harvest, and then it will average somewhere around 10%, I think, return, which you won't get on your bank account. So if you put in, and with 350 Rand of investment, go and find an investment where you get 10% average per year. That's it's hard to find. But with an investment like that, you can invest in farming, which is a solid investment, and you can do it with small amounts. So that's one way of starting. And we will look at some other ways as well. So risk management. How should you invest the money that you have available to invest? Now, there's obviously different opinions on that. My personal, and I think Geek is behind that also, we have similar beliefs in that, is invest about plus minus 40% of the money you have available for investment. Invest that in the lowest risk category. Low risk, high liquidity. So you need to be able to access your money fairly soon. The majority of your money, which is, I mean, it's not the majority, it's 40% of your money. You need to be able to access fairly fast in case there's an emergency, in case you need to pay something. So that money is low risk. It's quickly available. It's high liquidity, and it gives you returns anything between 0 and 10% per annum. So 40% should go into your lowest risk, high liquidity. About 30% should go into your medium risk investments. It's less liquidity. So maybe you have a 32-day notice that you have to give, or a 6-month notice, or a 12-month notice. So that could be fixed deposits that you do. Will generally give you between 8 and 20% per annum of returns. So it's still liquid, but with notice period. So you can still access it. It's not high risk. It's easier. It's easy available, but not as easy as the lowest risk. And then about 20% invested in higher risk, where there's lower liquidity, which is, so the money won't be accessible very quickly. Maybe there's a couple of years that you have to invest before you can get your return or your assets back, your investment back. And there's a return on investment of about 10 to 50% per annum. But it's high risk, so you could as well lose everything or partially of it. That's always the higher the risk, the higher the returns, but also the higher the risk of losing some of the money. That's why we say, don't do more than 20%, then you can't lose more than 20% of your assets. And then the high risk, or the highest risk, is the 10% of your money available to invest. That should go or could go into highest risk, which means you can literally lose 100% of those 10%. But you could also expect 50+% per year return on investment. That's a potential that is. You know, you've heard people saying, if it sounds too good to be true, it is too good to be true. Have you heard that? Now, I don't believe in that, honestly. I shouldn't say that in a finance teaching, but I honestly don't believe it. Sometimes there is investments, they do sound too good to be true, but they're not too good to be true. But if you don't do your research and you don't check it out well and you don't manage your risk well, it could become too good to be true. So many of those too good to be truths are really too good to be true. But it doesn't mean that 100% of them are. But then it is for you to go and do the research and check it out very, very carefully and very well. So again, this is not a rule, the 40, 30, 20, 10 principle. This is just a guideline that I like to live. Some of you might want to do higher risk or lower risks or no risk at all. That's fine. But if you go with a balance like this, I do think personally it's fairly balanced. It will help you and not to risk too much, but at the same time to expose yourself a little bit to risk, because no risk, no gain. And so you will have to have some sort of risk if you want to have bigger gain, and you just manage it well. All right, the next slide, and then I'm going to stop a moment again for questions. Is just the same slide again, just split out a little bit different and giving a bit more explanation. So the lowest risk would potentially be things like the savings accounts in your bank or in a safe at home. That's a very low risk and it's immediately available. So you can put money into your safe at home. I mean, there's still a risk that some thieves will come and steal your safe or put you at gunpoint to open your safe. But you also have a risk at the bank that the bank will close down or whatever. So there's always a risk. If you have money, there's always a risk, but it's the lowest possible risk. So having it on a savings account, having it in the safe at your home, having it into an investment account. There is investment accounts where you don't have to give notice. Investing it into gold or silver or gold coins, silver coins like the Krugerrand or the like. That is fairly low risk and it's fairly quickly available again. It's easy to sell gold, the Krugerrand gold coins. It's fairly easy to sell them and cash it in again. Gold and silver are usually crisis tested. When a crisis happens, usually they keep the value when a currency actually loses value. Sometimes it can initially lose a little bit of value as well. We saw it in the Corona crisis now. The gold value actually crushed a little bit in the beginning, initially, of the Corona crisis, but then it gained value again and it stabilized again. And while the Rand was crushing quite a bit, it's stabilizing a little bit right now, but I don't know how long that will last, to be honest. But gold and silver is a much more stable currency, even though most countries have eliminated the gold standard. Gold standard meaning that they will back up their currency, their fiat currency as it's called, the physical currencies. They used to back them up with gold reserves, but most countries have actually quit using the gold standard as a backup. And a lot of them have sold most of their gold reserves. Some of them still have some, but it's not backing up their full currency anymore. So even though people are not looking at the gold standard anymore, gold is still largely recognized as a standard, and therefore it's a very stable currency to put your money in. Then we have the medium risk. Medium risk would be things like investment funds. You have this, if you don't know, there's different funds that the banks and insurances and investment companies put out, where they put in a variety of bonds and shares and investments from different companies. They balance it out to balance the risk and mitigate the risk. And then you can buy a share for some of them also for fairly small amounts, 300, 400, 500 rands a month, or initially once off. You can invest in one of those investment funds, or even with larger amounts. You can have more risky ones and less risky ones, etc. But they still generally in the more medium risk area. Some of them might be in the higher risk if they're more share focused than they are bond focused. But yeah, so they would be between medium and higher risk, those investment funds. Then if you invest in property, it's also fairly medium risk. However, it's not as easily accessible. So if you want to cash your property in again, it's not that quick. So it's also between the medium and the high risk based on the liquidity. But property in general is not high risk. especially if you do your research. I mean, if you overpay for your property because you haven't done your market research, then it is high risk. But if you go according to market value and you know a little bit what you're doing, property is generally quite good. It keeps value. It actually increases value over time most of the times, especially if you have it invested long term and you don't want money back fairly soon. Bonds, bonds are companies, they offer bonds, or governments, they offer bonds to generate money, which they will pay interest. It's like a loan, that you loan money to a company or you loan money to a government, and then you get interest on that. So it's also fairly low risk or medium risk. And then small businesses, if you want to invest into a small business venture that you start yourself, or your kids start, or your relative starts, family business, if you want to invest into that, it can also be medium risk. But it could also be high risk. Depends on whether you research it well and whether it's a good potential. But if you find the right thing, it can actually really be medium risk. And then impact farming, that's what I just told you now with blueberries. They also do bee swarms, so you can buy a whole bee, what do you call it, folk cultivate, and then you harvest honey, or they harvest the honey. The farmers harvest honey for you, and then they sell it, and then you get your return from that. And they do the same with solar panels, PV, photovoltaic. So they create electricity, sell it to companies, and then you get your return there as well. But they are a bit more high in investment. So that would be, I think, a bee swarm is somewhere around 4,000 Rand, and solar is 5,000 Rand, and that's a 20 years investment. So you won't access that money very quickly, but it's fairly medium risk. It's not high risk because they also have insurance, and so it's really nicely set up. The higher risk, 20% that you want to invest there, it would be stocks and shares. So you maybe invest in your stock exchange, you trade with shares, maybe bigger business ventures where you maybe invest a bit more money, or maybe a bit more risky businesses where there's maybe more return. Maybe it's a guy that really has this brilliant idea and says, if you invest into my business, I will be able to really take it to a very great level. I will make a lot of profit, and I will share the profit with you. But at the same time, if it doesn't take off, you are at high risk to lose your money. Investment funds, I told you about the medium risk, but they're also in high risk if they're more share focused. And same with impact farming. Impact farming itself is not really high risk the way it's set up, but if you invest larger scales of money, it's less available. And yeah, you still do put money into someone else's hands, so there's still always a potential that you could lose it. Lastly, the highest risk, that would be if you trade with options and futures, or forex trading, cryptocurrency, or even some of the high volatile stocks and shares could also fall into there. Or high risk business ventures. Yeah, I don't have space there because it's only 10%, right? So it gives me only this little bar. So I don't have space to fill it up with options and stuff, but I think you get the idea. It's really very high risk that you can lose 100%. And then I went on a forex trading venture actually a couple of years back. It was very promising. The guys promised that they will trade forex with a what do you call it, a robot, computerized, and they will put 10% of every profit they put aside until your money is secured again, your initial investment is secured. So it sounded very good. They wanted to save some of the profit, put it aside to back up your initial investment, and then you would get profit each month up to, I think, up to 10% was the promise each month. And so I knew the guys that were setting it up, and I trusted them and still trust them. It's not that I don't trust them anymore, but it totally failed. So I put in some money that I was willing to, not willing, but I was okay if I would have to lose it. I wasn't willing to lose it, but I knew that if I had to lose it, or if I would lose it, it shouldn't hurt me too much. So I didn't put too much money in there, but I did put some money in there. And I said to my kids, if you guys want to also learn how to invest in high risk, you're welcome to give me 100 Rand, 50 Rand, 200 Rand, whatever you have in your pocket money or from your birthday money or whatever. If you want to invest something, tell me, and then I will put it into the Forex trading as well on your behalf, and I will give you the profit that you can get. And I started calculating if it's 10% every month, you could double your initial investment every 10 months. So after 10 months, if you invest 100 Rand, you will have 200 Rand. After 20 months, you have 400 Rand. After 30 months, you will have 800 Rand and so on. So it's compounding interest and it goes progressively, right? So it's very tempting for any child and every adult to go like that. So then they decided and they came and they said, okay, we want to invest. And I said, okay, but think twice because you might never see that money again. So I now put you the sugar through the mouth that this is what you could potentially earn. But at the same time, it's also possible that you will never see the money again. So do you want to? So my son came with, I think, 100 Rand and he says, I want to invest that. So I said, are you sure? Because you could lose the full 100 Rand. You will never see it again. He says, yeah, but there's also a chance I could win. I said, yes, there's a chance you can win, but there's a chance you can lose. So you need to be happy to lose that 100 Rand. And he was hesitating a bit, but after a while he says, yes, I'm doing it. And so did my daughters. They came in with 50 Rand. And the youngest one, she came and she gave me the 50 Rand. She says, Daddy, I really, really, really don't want to lose these 50 Rands. But if I do, it's okay. So she gave me permission to invest 50 Rand. So I did. And for a few months, it went really well and it was exciting. And we celebrated together every time we saw. It wasn't 10% each month. It was more like 5%, 3%, somewhere there. I don't even remember if they promised me 10%, but they did promise some good return. And I think it was around 3-5% somewhere there that I've got every month. But then all of a sudden, their robot had a mistake or something, but they lost everything. Not everything, 97%. So we were left with 3% of what we invested. Now we had to decide whether we're going to take it out or whether we're going to leave it there. Now I don't believe into how you say that in English? I don't have the English words now. Into cashing in your losses too early. I believe if you cash in your loss, then it's actually really a loss. But if you leave it in long enough, then it can maybe recover. So I sort of hope that it will recover over the years. But now even 2 years down the line, it hasn't recovered. I'm still at about 3-4%. And so eventually I took it out with the permission of my kids. That now from their 100 Rand, they have 3 Rand left. For the 50 Rand, they have 150 left. But we reinvested it into another high risk option because we said already we've lost. So whether we have 3 Rand or 0 Rand doesn't make a big deal now. But if we can invest the 3 Rand into another high risk, high profit promising option, then maybe we can actually recover it. And right now it is actually busy recovering sort of. But it will still take a long time to recover 97%, right? And it is high risk, so we might lose everything again in a few months from now. But it's a nice game, but it's really gambling. So the highest risk sector is really close to gambling. You can do your research, you can research well, and some of them are really legit things. And why not trying it then if you've done your research? But that's why it's on the 10% and not on the 40% level, right? You don't want to invest anything there that you're not prepared to also lose. But the potential is that you will really gain a lot out of it. And if you realize that profit early enough, so if you cash in your profit early enough, then you can't lose it again because you cashed it in. And so it will be for you to have the right feeler and the right timing also to cash in a profit so that you can secure it and then maybe invest your profit into a higher or medium risk or even lowest risk area. But again, that's also personality type. Some people don't like risk at all. Then stay away from the red section here. Don't do highest risk. Then maybe go for the higher or the medium. But don't just stay on the lowest risk. You will not be able to build your assets. It's not going to work. You will have to have a bit of a diversification or variety in your portfolio. All right. Before I'm gonna continue, I do believe there's questions now, so I'm gonna give you some room here. If you have any questions, please unmute yourself and speak up.
Bruno, I've got a question on gold investment.
Yes.
You don't have to spend a lot of time on it, but just give us a quick idea. How would you do it? You mentioned Krugerrands. I'm not too familiar with that world at all. So if you could just give us a brief view of that.
Yeah, absolutely. So there's a lot of scams out there as well. So it's good that you asked that question, Carl. You know, there's people, they invest gold into companies that tell them they're buying gold on their behalf, keep it in a safe, and they will give you a certificate for the amount of gold that you have. Now that certificate is worthless unless you've actually seen that physical gold in their safe. They can tell you anything. If they can't prove you that they have the gold actually physically in their safe, then it's not a gold investment. And if then their investment crashes somehow, then you won't have gold against your certificate, even if they've given you a certificate. So I tend to believe never invest into gold or silver unless you have it physically in your own hands, or you trust, you've seen with your own eyes that the company that you're investing with, they actually have the physical gold and they put it in the safe, and then you know it's safe. So gold you can buy with banks. I'm actually, to be very honest, I'm not too familiar how it works exactly in South Africa, because I haven't bought gold in South Africa myself. I've done it in Switzerland. In Switzerland, you buy it at the banks. You buy gold bars, or you buy gold coins, like the Krugerrand or other coins, like the Swiss gold coins, there's American gold coins, American Eagle, and others. But they're physical gold, and so that physical gold has a physical value. And I think in South Africa you also can buy at the banks, but you can also buy with coin traders, gold traders. There's plenty of those around. And yeah, but I haven't done it myself, but I know it works in South Africa as well. And then have it physically, either in your own safe at home or in a safe at your bank or somewhere else where you can keep it safe. But don't buy shares where you get a paper certificate and you don't have it in your own hands. I know GIG, the GIG CFI also allows its members to buy gold and then keep it in GIG's safe. Now, that one I trust because I know the guys. I was part of the board of GIG myself, and I know they do actually buy physical gold. They put it in a safe and it's there until you sell it, and then they will sell it again on your behalf and you will get the cash. So yeah, but make sure when you do things like that, it's really with a trusted company where you know that the physical gold is really there and it's not a scam. I hope that helps, Carol. Good. Anyone else on anything?
I guess my question, for a while, there was this temptation with the Bitcoins and how it like virally went like all over the net, but like any scam or anything, but how some of these things promise you like it will go so quick and you'll make so much money if you invest this.
Yeah, look, Bitcoin, I'm going to cover on that. It is among the high risk investments, as you can see. Although I do have a little bit of an opinion about Bitcoin, which I'm going to share with you, my personal views. But I've reserved a full section for that because I've had a few questions from different people within this group, but also outside this group recently. It's something that is coming up a lot in these times, also because Corona gives people time to research and to to get exposed to such things. So I'm going to give you my personal opinion, which is really my personal opinion. It's not GIG's opinion. It's not Waram's opinion. It's my personal Bruno opinion. But that will be the next section. Anyone else on anything that I've shared until now?
No, on the impact farming. If you could just give us a directive somewhere along the line, I'm very interested in that. And then, just somehow, how do we connect with CFI, and what they are doing?
Look, I'm not going to do that here. I'm preferring to do that in private. So you can send me a message or email after the session if you're interested in any of the things that I've shared with you, and then I'm gladly going to connect you with the different options. But I don't want this to be an advertisement platform where people think I want to advertise certain things, because that's not what this session is all about. I do mention those things because I've experienced them, and I highly recommend them, because I can see it's great opportunities even for smaller investments to get going. But that's why I'm doing it, and not to to abuse it as an advertisement platform. So in personal, I'll be happy to give you links and connect you and so on. But you would need to reach out to me and send me a message, and then I'll do that. Yeah. I'm sorry, I just need to quickly switch off the gas here next door. Yeah. There we go. Sorry, I had a little gas heater. That's why I'm so nicely warm. I'm getting red ears right now. But the gas is off now, so I had to switch it off. Good. Anyone else?
I guess the question would be also, since this is kind of new, and when you don't really know where to invest or how to invest, and then like getting, I don't know, a financial advisor or because when I look at stocks and shares, I have no clue where to invest or what to invest. So your advice would be to maybe get a professional financial advisor or someone who knows.
Yes and no. Yes, you will need advice, and you will need advice from someone that knows what they're talking about. Why I say and no is because I've worked as a banker, so I know how banks work and financial institutions. And I shouldn't mention the number because this video is going to go online and public, but I personally believe 98% of all financial advisors that work for a financial institution, they will not give you advice for your best interest. They will give you advice for the institution's best interest and their own best interest. They live off commission of the things they sell you. That's the one thing. But even if they don't, even if they just live on a salary, like when I was working at the bank, I didn't get commission on things I sold, but I got a salary, and there was always competitions where the bank would push a product and say, if you sell so many of these, then there will be a celebration, and you will be having a free meal, or something like a. So there was always competitions. There was always reasons why you should push this particular product, and of course, then you will sell this product to the customers, making him believe it's for their best interest, while actually it's for your best interest because you got motivated by the bank. And even if there's no competition, the bank will still tell you, they will send you to training, and they will train you the way they want you to be trained so that it benefits them the best. I was a bit offended when I was working at the bank. My grandfather kept on saying, I don't trust the banks because they never lose. It's always someone else that loses, but the bank never loses out. And I felt a little bit offended because he kept on challenging me when I was working as a banker. But he was right. I could see that. I observed that over the years. And that's why I don't trust financial advisors easily, unless I really know they working now not for their interest, and they don't have a reason why they should do it. So I have a few friends that I really trust, that I run things by. I've obviously now also obtained quite a lot of my own knowledge and expertise, which I also rely on myself. But I will always or most of the times, double check my strategies with some of my friends, just to run it by them. And yeah, so that's why, yes, get someone to help you, but make sure it's someone that really has your best interest in their mind and not their own pocket.
I don't know, where would you find such a person?
Well, you're talking to one of them right now to some extent. I'm not claiming that I can give you all the advice when it comes to stocks and shares and stuff like that, but in some areas I can, and in some areas I will tell you I can't give you advice. Yeah, gig wealth coaches have some experience, but not all of it. So that's something. But then there's good people out there. You might know some in your church, you know, in your friends circles. Yeah, sometimes it's just about talking about it openly with someone, you know. I tend to believe also sometimes it's good to just look around a little bit around you. Where are people that are really successful in life? You know, maybe guys that have successfully built a business and maybe sold their business. Chat with them and ask a little bit from their input, how they would do it. You know, how do they get their advice? Even maybe they might not want to give you advice, but they might want to give you the advice where they get their advice from. And you can learn a lot from the guys who have already done it themselves and have successfully, you know, proven themselves. And I think that's the kind of guys you want to seek, and not the kind of guys that have learned it somewhere but haven't lived it themselves.
Thanks.
Anyone else? All right, then let me move to the next slide, which will talk a little bit more about cryptocurrency, or Bitcoin, and then we're going to move a little bit further also into the next steps of 3-generational planning. We don't want to get stuck, and I see we only have half an hour left. High risk. When you go into, or if you go into high risk, for some of you it will be when, and for others it will be if. If you go into the high risk, the number one commandment would be always research well. Research your investment opportunity really well. Go and look it up on the internet. Is there any reviews that you can find? Find friends that maybe might know the investment opportunity. What is their experience? Read up on well-known reviewers of such things, of such investment opportunities. See if it's a legit company. Maybe try to find the owners or the board or the company. Do they have an office, or don't they have an office? Can you contact them? Can you call them? Can you be in contact with a physical person, and will they actually want to speak to you, or are they avoiding to speak to you? All these kind of things already will help you to determine the scams quicker. You know, you will never be, if you go into high risk, you will never be 100% sure that it's not a scam. But if you have a few cautionary measures in place, you will more likely find the scams and avoid them and not invest into any scam. As I said to you, the Forex trading that I did, that wasn't a scam, and I still lost 97% of my investment. It wasn't a scam, but it was just very high risk, and that's what happens with high risk. And I still know the guys, I still trust them, and they're still going on with their venture, and maybe one day they will still succeed, and that's great. So not everything where you can lose money is a scam, but there's a lot of scams out there. So research well, make sure that you put some of the safety measures in place. Only invest what you can afford to lose. We touched on that. Example of my kids, make sure you understand it to the same level as my kids did, that they really, really don't want to lose it, but it's okay if I do. You know, if you can't say that, it's okay if I lose it, then don't invest it in high risk. Just don't do it. It will not be worth it. Diversify within the high risk investment. So don't put all your money on one horse, you know, even within the high risk. So don't go over the 10% of the money available, first of all, but then within those 10%, diversified even in different options. I have, right now, I have 2 investments in high risk. So I don't put all my money into one. I put it into 2 different ones, and they're diversified a little bit in that sense. And again, it's only money that I can afford to lose. It's not money that will put me into trouble if I do lose it. Crypto, Bitcoin. So my personal view on that. Again, it's my personal view. It's nobody else's view. It's my view, and you don't have to share it. First of all, what is Bitcoin or cryptocurrency? I can actually only really speak about Bitcoin because that's the one I've really familiarized myself very, very deeply. I can't speak about other crypto so much. They have the same technology behind it, but even that blockchain technology is applied differently with different coins. So the Bitcoin is a blockchain technology which you have to mine. So basically it's like gold mining. They mine in the electronic world, codes, it's coding. And the moment they mine the whole block, then as a reward, they get a certain amount of Bitcoins for that block that they've mined. And initially, I think it was 1 Bitcoin per block, and then it became less and less or something like that. I don't remember if it's 1 Bitcoin or, yeah, I don't remember the amounts, but you got a certain amount of Bitcoins per block, and then every few years it halves the amount of Bitcoins you get per block. So you get less, half as much. The reason why they're doing is they only issue, or there's only going to be available a certain amount. I think it's 12 billion Bitcoins. Don't keep me accountable on that now. You can go and Google it. There's a certain amount of Bitcoins that they will make available, and then there will be no more of those Bitcoins. That's what it will be. So inflation, that's what they're hoping. Inflation will not happen, because inflation usually happens when governments print more money to put it into the circulation of an economy. But with Bitcoin, right now it's more Bitcoin is being produced, but it will gap somewhere, and then no more can be produced. And then that's the Bitcoin that is available. And if there's no more, what do you say, no more Bitcoin available than what is available, then the Bitcoin value might spike up significantly, because that's all there is. There will never be more. And that's a way of them trying to get around inflation, to make a currency that is inflation proof. The good thing about cryptocurrencies also, you can do instant transfer. So it's not like the bank transfers from one country to the other that takes weeks sometimes for the money to arrive in a bank account. With cryptocurrency, it's all electronic, and the technology allows it to be instant, within minutes, to be transferred from one person to the other. And it's anonymous, which goes around, obviously, the finance systems, but at the same time, it also opens it up for a whole lot of scams and a whole lot of money laundering and so on. That's the downside of it. So that's in a nutshell what is Bitcoin. Bitcoin has been around now, I think, almost 10 years, if I'm not wrong. I think 2011, somewhere there it started. And since then it has done spikes. It's highly, what do you call that in English? Come on. Got the word.
Volatile.
Volatile. Yeah. Yes, volatile, but also when it's like a gamble, right? You basically you invest money hoping it will go up, but it can also fall quite a bit. Bitcoin is not officially recognized as a currency in South Africa. It is recognized as an asset, almost like a share or a stock. It is an asset, and that's also how you will have to declare it for tax purposes. You declare it as an asset, and if the value of a Bitcoin raises, you will pay property gains taxes, or property gain taxes. And so that's how it's been treated, or is being treated in South Africa. All right, that's in a nutshell what Bitcoin is. You can go and read up yourself a bit more. There's lots of information available. Maybe start with Wikipedia, because that's a little bit more, just neutral, the way it's explained. And then if you go for other sites, some of them are obviously quite excited to win you over for Bitcoin. As I said, it's high risk, but at the same time, I would think, especially with a currency like South African Rand, which is also high risk, it can be a valuable addition to your portfolio if the risk is managed well. So I initially was very skeptical when it came to Bitcoin. But as I read more and as I researched more and as I observed it also over the years, the development, Bitcoin has a tendency of actually really becoming stronger, and especially towards more volatile currencies like the Rand and other volatile currencies, it can be a good haven for you to invest a little bit into it to secure the value of that money that you invest there, because it might actually, even though it is high risk, not to forget that, especially against dollar and Swiss franc and so on, it can be losing value very quickly. But against the Rand, chances are that in the long run it will actually gain value and it will give you more Rand against the Bitcoin. So it can be a valuable addition to portfolio. There's two ways on how you invest Bitcoin. One way is you just buy Bitcoin and keep it in your wallet, in your Bitcoin wallet on an account, basically. That's what it is. You keep it there and then you just hope that it will increase in value. And then when you want to sell it again, you sell it again against Rand, and then you got Rand in return. And maybe hopefully with a profit. And if you do have a profit, then that profit you will have to declare as a property gain in your tax statement. If you want to do a little bit more with your Bitcoin, you could also invest it into investment opportunities that work with Bitcoin as if it were a currency. So like Forex trading, there is Forex tradings, they work only in Bitcoin. So they will take your Bitcoin, they trade it against other currencies. And then if they make profit, they give you a share in profit. So in that way, your Bitcoin not only has a potential to gain in value, but also you have a potential to increase the amount of your Bitcoin slowly but surely. Of course, you also have the potential to lose your Bitcoin because it's invested into a business opportunity that can go down the drain. So that's the risk you will have to weigh up and to research and to come to terms with if you want to do that or not. So there's different options. So I'm not as negative towards Bitcoin anymore as I used to be in the past. I personally think there is value into it, but it has to, in my personal opinion, it has to be treated as highest risk. It is very volatile, it's very risky. You could lose everything as much as you could also make a huge profit, like some people have done. Why not you? But having said that, why shouldn't you lose all of it? Because a lot of people also have lost. So that's my take on Bitcoin. Any questions or remarks? I see a question here, but I don't understand it. So Michael, you can maybe send me an email afterwards to ask you a question, and we can talk about that. All right, then let me move on. So we're talking now about next steps in your 3-generational planning. So one thing I would suggest or propose to you is draw up a family constitution. So that's more on the value level, right? You draw out your values, you write them down. What are your family values? How would you like your family see developed? What are some of the cores that are important to you as a family? And then write it down and agree with it. If you have kids that are already in an age where you can have discussions, draw them into those discussions, have them be part of it, and help them to buy into it so that you have an agreement. Maybe draw your parents or even your grandparents in if you can and ask them, what are some of the core values that were important to you that you wanted to install in us as kids and grandkids? And then some of them you might want to involve them or include them in your family constitution. So that's really a value paper, where you draw up your values, your family values, but it will help you in the estate planning as well as you move forward, because those values will be, you will run your investments against your values. You will run decisions, larger, important decisions of your family, you will run it against your values and make decisions according to that. Another thing that I would highly suggest, even if you don't have much money yet, have a will drafted with someone that can do it. today lots of the banks and insurances, they offer you free drafting of wills. Well, it's actually not free, because they will charge you fees for, so they will already make sure that they will be the executors of your will, and they will charge the fee based on the execution that they will do of the will. So it is one option. There's also lawyers that you can go and have wills drafted, which I find is the better solution, because lawyers often also do it for free or for a very small fee, nominal fee. And they're much more willing also to negotiate on the percentage that they would take if they would be the executors of your will. But the moment you have kids, I would suggest draft the will so that it's clear what will happen if one of you dies, and that it's clearly regulated already. I would also, in a South African context where funerals have a high standard and a high value, to the extent that even during lockdown, you can still have funerals with 50 people, up to 50 people. So that shows me there's a high value in funerals. And I know that there's usually lots of money involved in terms of spending for meals, and there's a lot of expectation. So I would highly recommend in a South African context to have a funeral cover. There's good funeral covers in the market that are affordable. There is not so good ones also. So do your research, see what is really fair priced. But I would suggest have a funeral cover so that if you or one of your family dies, it's not eating away all the assets that you've built over the years, but that you can cover for those expenses and still have assets that you leave behind. And then the next step, again, is paperwork, but maybe draft a 1 year, a 7 year, a 21 years, and a 50 years plan, and then revisit them. Why 1, 7, 21, and 50? You could also say 49, a bit more biblical number there, but 1 year, because that's still fairly easy to see. Where do I want me and my family to be in 1 year, in terms of education, in terms of jobs or ministry, and then also in terms of finances? What are going to be our needs as a family in 1 year? Maybe you're pregnant, and in a year you will need more finances to take care of the child that will have been born by then. So all these things, try to consider that in your 1 year plan. Then your 7 year plans will be, maybe your child will be 7 by then, or maybe it will be 14 years, or maybe it will be 21, depending how old they are. Right now, maybe you don't even have children yet, and maybe in 7 years you're planning to have children, or whatever it might be. But start thinking ahead already. What will be needed in 7 years? Where would I need to be financially? Where would I need to be emotionally, spiritually, and so on? Write those things down and plan them. And that will give you now, as you do that annually, every year you review those plans and visions. And then as you keep them ahead, it's almost like when I don't know if you've ever been kayaking. I used to kayak on the lake in Switzerland. So if I wanted to go straight on the lake, I had to fix on a point far in the back and fixate my eye on it so that I would go straight. And then I would go totally straight with my boat, with my kayak. And that's the same thing here. When you draft a 1, 7, 21, and 50 year plan, you actually give the eye something to fixate on and to focus, and then to move towards that. You might not exactly reach what you write down, but you will be at least on track to some extent. 21 years, why 21 years? Because usually that's sort of a first generation that has passed, right? That has become adult. So what do you want to have when your kids are turning 21? Maybe you can be at a point where you can give them sort of a startup into their studies. You give them, like, instead of them having to get a student loan, you'll be able to give them some assets that they can use towards their studies, or maybe you give them a car or whatever. But what is it that you would like to make available for your kids when they turn 21? And where would you have to be financially? And in 50 years, that's more towards your pension. What would need to be in place for me then? And so on. And you can go on. You can have a 120 years plan also, in terms of what would need to be for the next generation after my kids, and so on. So draft those plans as a family, especially as parents. If you can and want to draw in your kids, it's even more beautiful. and then review them, revisit them, and then start planning accordingly, even in the way you live. The next step, maybe later, not maybe initially, but once you start having some money that you can really invest into medium or larger investment opportunities, it might be worth establishing a trust. Maybe before you buy your first own property, you might want to establish a trust and buy the property into the trust. That's something to consider, right? A family trust is basically a way of taking your assets out of your own entity, of your private entity, and put it into a more institutionalized entity. Now, the family trust is still part of you. It's not an own, what do you call it, institutional person, but it's something in between, really. But it helps you to secure assets, and you can give the trust a purpose. Usually it's linked with your family constitution up here, but you give your trust a purpose. What is it for? And usually a trust is there to provide funds and support to its beneficiaries, which is the family and its descendants, right? So you can define who are exactly the beneficiaries, and then what kind of business should the trust do to come up with money, and then that money should, or the assets also, should take care of the family as much as it can. So a family trust can also be a good thing as part of your will. If one of you or both of you die, then it could be that your assets that you have, your belongings, should go straight into a family trust, which then will take care of your kids and their descendants. Right. So that's one thing I would highly consider if I were you, and if I had some money already that I can invest into something larger like a property or things like that. And then a step much further would even then be having a family office, which usually is also linked to the family trust, where, a family trust has at least 3 trustees, of which 2 can be from the family, and the third one needs to be outside the family, independent trustee. With a family office, you would basically run your family wealth planning as an actual office, and they would be there for the family to invest the assets of the trust, but also to determine where is a need in the family that needs provision, that needs help, that needs support. Now that's now really dreaming, right? Talking about family office is not something that most of us will now do immediately, but that's something that you could work towards it as part of the growth of your family trust. That's what basically the really wealthy people will have for their own wealth management or estate planning. They will have a family office to take care of the provision for their family. And lastly, read, learn, educate yourself ongoing. That is the best thing you can do in terms of your estate planning. Never stop learning, never stop educating yourself. Read up on things. Like I told you with my Bitcoin thing, I was really skeptical. I was against it for many years until I started really realizing, man, I can also learn something. I don't just have to be negative about something. So I started researching, reading, talking to friends, asking their opinion, talking to auditors, talking to financial experts. So to establish an opinion and to establish an expertise on it. And now the next step for me was to start investing in Bitcoin, so that I actually really experiencing it myself, and I can talk out of experience, not just out of textbooks, right? And talking after what other people have said. But now I'm experiencing it myself, and I might make good experience or I might make losses. But that's part of my learning curve. That's the tuition fee that I will be paying if I lose. So you have to look at it like that. That sometimes your loss is not really a loss; it's tuition fee that you're paying to gain experience. So read, learn, educate yourself ongoingly. And 2 suggestions that I would give you now to start off with, if you want to learn more about a 3-generational mindset, would be to read that book, Legacy by Jasper Kloete. Jasper is the founder of GIG, Generational Inheritance Group. He's written that book where it basically explains the whole GIG philosophy, the 3-generational mindset, and how to do estate planning. Most of what I've shared with you is in much more detail with some other words as well. He's explained those steps from from struggle to significance, basically. And yeah, it's a brilliant book. I have physical copies for those who are close to me. You can buy them for, I think, 150 Rand, if I'm not wrong. I have to look it up. But they're also available on Kindle if you want the electronic version, or even on Audible if you want to rather listen to the book. So it's a good place to start if you want to grow more in the area of 3-generational mindset. And then there's free education available on giginstitute.com. So if you look that webpage up, gig-institute.com, you can sign up for free. There's no strings attached. That's why this is the only advertisement I'm doing tonight, because there's you cannot think that I'm gaining anything out of it, because it's free and it will always be free. So you just sign up there with your personal account, and then you have access to ongoing training. There's videos, there's webinar recordings, there's they have a YouTube channel that you can access through them as well, through that webpage. We have weekly webinars, recordings that you can access, and yeah, it's really brilliant stuff from people like you and me, people that are on their way, on their journey, in the 3-generational journey, and some of them who have already gone ahead of us and can teach us from their expertise as well. So it's a good opportunity for you to grow more in that mindset. Of course, there is paid options when you then move to the Gig CFA and want to make use of the banking option. But if you just stay within the Gig Institute, you have free access, lifelong free access to everything that they post on their webpage. They will not start charging there. All right. So I'm at the end of my presentation, which leaves us again for questions, remarks, before we close. But I just want to give you that opportunity. If you have any more questions or remarks that you'd like to put up here.
Bruno, I just want to mention something. It's a comment on the one hand more, but whoever considers a family trust just needs to update themselves on the latest laws, and also to put property into trust. There's been quite a lot of change in legislation as far as I know, and it's not such a attractive option, especially with property.
Yeah.
I don't know how much you know about it or anybody else, but you really need to look well at it and perhaps get a tax consultant's input on it, because it can be quite a big problem if you don't know what's...
No, absolutely. And family trust, you should never even try to draft yourself. You will need a professional. There's great companies out there that are specialized in drafting family trusts or trusts in general. And so I would that's usually law firms, or it could also be financial advisory firms. But I can also connect you with one or two that are good with that, if anyone is interested in the future. But you never do that on your own. You always throw in a professional. You pay them a fee. It's not for free. You will have to pay them a fee. It will be, I don't know, I think I paid about, if I'm not wrong, I paid around 1,200 Rand or something like that once off. But then I have a professional drafting it for me and giving me the understanding also on what makes sense and what does not make sense to put into a trust. Yeah, absolutely. Anyone else?
Bruno, you made a comment about asking people for input. And I just want to say, from my experience, I've always been interested in being in the stock market. But because I was in missions, I never had money to put into the stock market, etc. But I continued speaking to people, and I found a friend who has a lot of money in the stock market. And so I started talking to him. I said, will you teach me? And before long, he said, yeah, let's open an account and I'll move some of my stock into your account and you can start playing with it.
Wow.
And before long, you know, I had substantial money in the stock market. But the point is, we must not be scared to ask people, because there's a lot of older folk who would love to teach younger folk what to do.
Yes. Awesome. And I think the point you're also making there, Graham, is you've asked someone that has done it themselves and are successful in it. They're experts in their field because they're doing it for themselves. They're not advising other people what they should be doing. No, they're doing it for themselves. And therefore they have valuable advice to give, because they won't give you advice that they wouldn't do themselves for themselves either.
Yeah. Yeah.
Awesome. Thank you for sharing that. That's great.
Just as a matter of interest, is the GIG Institute a South African institute, or yeah?
Yeah, so whatever I shared. So the GIG Institute itself can be accessed from anywhere in the world for the free membership. So even if you're zooming in from Madagascar or from the US or wherever you are in the Netherlands, you can still be part of the GIG Institute and learn or get the free educational videos and so on. But if you wanted to make use of the GIG Cooperative, that one is only available right now for South Africans. There's visions and dreams of eventually launching it into other countries as well, but for now it's only available in South Africa, the cooperative, the bank part of it. If there's no more questions, which it seems to be the case, there's nothing that I see and hear. Just one last advertisement is the Micro Business Startup Program, which we're launching starting next Monday. So if you've gotten into a swing of attending my webinars and my Zoom meetings, you can just continue next Monday. It will be 2 hours earlier. We will do it from 6 to 8 every Monday and every Wednesday for 12 weeks. So it's quite a commitment, but we can offer it. It's a fully equipped online schooling with online material, access to exercises and stuff. So it's a bit more sophisticated than what we've done now over the past 5 evenings. It's a full-blown program. We normally run that same program in person, contact class. This time we're trying it for the first time online for 12 weeks, 4 hours a week plus homework assignments. But you will come out at the end of those 12 weeks with a full-blown business plan for your own business. Whether you've started it already or whether you don't even know yet what kind of business you want to start, you will have a business plan that has a high probability of success, because you work through the steps of drafting a business plan, of doing the research, of really well establish the business plan. For South Africans, I have a special for 645 Rand due to sponsorships we're getting from the Swiss NPO for Africa. For everyone else, it's also fairly cheap, I would say. For the rest of Africa, we can offer it at 199 US. For the Asians and South Americans, we can offer it at 299 US, and for the rest of the world for 399 US, which I think is still a very, very cheap deal for what we are offering you, because we're literally going to help you to have a high chance of being successful in the long run in business. But 70% of all business, they fail within the first 2 years. And with our program, the guy who developed it, the South African, he has a 70+% success rate after 5 years of people being in business, still being in business. 70% of the guys who have done this and completed this. And so it's a very, very proven system. It's available in different languages. We're going to do it in English. And if you or anyone that you know in your networks wants to join, please don't hesitate to apply now, because you still will have to do an online assessment before Monday. And I can only give you the link for our Zoom session once you've passed that assessment. So yeah, a very warm invitation. And then maybe quickly, last option, if you have any questions in regards to that one. All right, and if that's not the case, again, thank you so much for joining us for the last 5 weeks. I really enjoyed it more and more each time, actually. I'm becoming more comfortable, and I really enjoyed to see your faces coming again, which also showed me that it seemed to have worked for you. And yeah, thanks for your interest. I hope it will benefit you in the long run. And again, what I've offered you last week, if you need any help in any way in the next few days, weeks, months, or even years to come, don't hesitate to contact me. You've got my email, you've got me on Facebook. Yeah, then I will try to help you myself or connect you with someone that can help you in this area. Because my heart is that you too will go into the impact phase eventually, and we'll start again drawing others up those steps, so that we have that circle going around and around and around, and getting others out of hopelessness into the impact phase, into 3-generational mindset. So God bless you. It was great having you guys, and have a good sleep. Bye-bye.